in many cases is just around the corner. And so I'm really, really big on this idea of protecting your investments because I kind of feel like it's going to get messy. But then what I'm going to do is I'm going to read an article to you that kind of describes the frenzy in terms of what's going on right now, what everyone is saying, and then I will give you my take on it, my assessment of the situation, so that you can make the decision that works best for you. And also, I'll give you a couple of stocks that I like. I mentioned one this morning, and then I found another one that I like that I'm going to buy. So we'll talk about that in 1 second here. So I hope everybody's doing good. And I hope you're investing consistently. If you're investing consistently, let me know. And um, okay. All right. So here is I'm going to give you kind of the pros and cons of what's going on in the markets now. And then we'll kind of just sort of discuss this from a financial therapeutic standpoint so that you can kind of sort of make the decision that works best for you and your family. All right. So hopping in, first I want to say hello to Khalil. I see you, Khalil, in Odessa. And let's see who else is in here. Let's see, I see Donna and Natasha and is it Antoine Alfred Kitchen? Good to see you. And Ayana, welcome, welcome, welcome. So good to see everybody. And so let me jump right in. Okay. So this article is in MSNBC or CNBC, and I'm gonna read this to you. And it says that investors are the most bullish since November 2021. And this is a survey that they just did. It says optimism is high on Wall Street at the midpoint of the year. So the market's feeling very, very good. Investors are the most bullish they have been since November 2021, according to the Global Fund Manager Survey. So they survey fund managers. And this is what makes it interesting to me is because if they were to just survey retail investors, that would be different from surveying people that make money managing stocks. So that's a different crowd. So this is really interesting to me. It says not only are portfolio managers not anticipating a recession, but they are betting big on stocks, especially the Magnificent Seven, which is some of with seven of the biggest tech companies in the world, Facebook and Nvidia and Apple and Microsoft and Tesla, etc. All right, it said they say all appears to be well on the market's front. Halfway through 2024, the S&P 500 and the Nasdaq Composite are each at records on Monday, closing once again at all-time highs. The broad market index is now a stone's throw away from 5,500, a milestone that would have flabbergasted many strategists just at the start of this year. So just at the start of this year, none of the experts thought we'd be hitting 5,500 for the S&P 500. That's a big deal. This is a very peculiar year. They said June FMS sentiment is at the most bullish level since November 2021, wrote Bank of America investment strategist Michael Hartnett. Our broadest measure of FMS sentiment based on cash levels, equity allocation, economic growth expectations inched higher to 6.03 from 5.99 last month. Still, the optimism has some investors concerned that a reversal is on the way. I'm one of those people. I'm one of those experts that's concerned that a reversal is on the way. Let me show y'all something. I haven't even looked at this chart yet, but let me see if I can pull this up and let me see if it looks the way I think it's going to look. Okay. All right. So let me see if I can find a chart of the S&P, and I'm going to go back a little bit. I'm going to go back about 5 years. So let me see what I got here. Okay. All right. Yeah. Yeah. This. Okay. Yeah. 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 Okay. Nice. All right. So let me show y'all this really quick. I'm gonna share my screen, and I want you to look at this with me real fast. All right. Can y'all hear me? Okay. Give me a quick yes if you can hear me. Okay. Let me know. Am I coming through all right? I was talking kind of low. Give me a yes. Let me know my mic's good. Okay. Thank you, Odessa and Antoinette. I appreciate you. All right. So here is a chart of the S&P 500. And this goes back over the last few years, last 5 years. Now, if you notice in this article, first thing they said is that it's investors are the most bullish since November of 2021. Now let's just look at November 2021 and let's see if we see any patterns here. So look at this is when the whole world went crazy, they told you to go in the house or you're gonna die if you talk to your neighbor. And then you saw this rise. This is when all the financial influencers. This was the birth of probably 100,000 financial influencers on the internet because all these people that had nothing to do suddenly decided, hey, I'm bored and I took one class, so I'm going to go and teach people how to invest in the stock market because now I'm an expert because I have nothing to do and I made $20 on stocks. So I'm going to go sell a class. So here you had just the rise of a large number of financial influencers. In fact, I say the majority of them actually came out during the pandemic, the good ones and the bad ones, including the ones who didn't know what they were talking about. And so here you see this rise, and this rise, it goes all the way through 2020. Then you go into 2021, and you just see it's just a party. It's just a big financial party, and everybody looks like a genius when you look at the stock market. Everybody looks like a genius when the party is going on because everything is going up. So when you see somebody on the internet that says, "Hey, I just invested $2,000 in stock options and I made 20,000," well, that's of course that's going to happen because everything's going up. It's very easy to make money in a bullish market. It's like shooting fish in a barrel, except there is no barrel and you don't actually have to hit any fish. It's like shooting fish that are in your stomach. Like that's how easy it is to make money when the market's going up like this. This is why I want you all to be invested because these are the fun times. This is when the good times roll. So you see, let's go through 2021. Okay, going through what is September, October, November, December. Okay. So this is the point that they talk about in this article. November 2021. And now let's see what happened after November 2021. This is about the time where I remember getting a little bit concerned because I said the frenzy is kind of crazy. Everybody's investing in anything. There were 12,100 cryptocurrencies that were taken off the market because they were fake and people were buying them just because they were invested in anything. This is called irrational exuberance. And I took a big chunk, maybe a couple $100,000 out of my stocks, and I said, let me go put this in real estate because I don't want my money in the stock market when the crash occurs, not if, when. So then, and it wasn't so much per se a crash, but if you look here, go to the other side of this mountain, you start seeing the decline, right? So you got November 4,600, and then by March you're down to 4,300. And then by June, you're down to 3,600 in the S&P. Now, and then you have some periods, a pretty somewhat flat region, and then you start seeing a little bit of an upward trend again. So now what you're seeing here, if you look at this section here, this is 2000, going back to October 2023. If you start here and you work up here, I want you to notice how this region here looks similar to this region here. The only difference is that this region lasted a lot longer. And the reason that this region, in my view, lasted a lot longer is because you had absolutely ridiculously insane Fed monetary policy. Around this time, the Federal Reserve, because everyone thought the pandemic was going to cause a prolonged stock market crash and a prolonged recession, they were pumping so much money into the economy that it was insane. I could not believe what they were doing because the whole time, people like Muhammad El Arian and others, Lawrence Summers, economists I respect, were saying if you keep doing this, you are going to have a horrible inflation problem. You are going to balloon the national debt to a level that is unsustainable. What are you doing? And they kept doing it and doing it. I had no idea why, but what that does is that will pump up, that will cause what you call asset inflation. So you think regular inflation was bad, asset inflation is like double that sometimes. So basically, you pushed up the prices of real assets when you're pumping money into the economy. You pushed up the price of stocks. You pushed up the price of real estate. Everything went up. So what do we have now in the economy today? Well, we have an economy where 4 years after the pandemic, the cost of a home is about 40% higher than it was in 2020. Is anybody else concerned about this, or is it just me? This is crazy. This is not supposed to happen. National debt. If I show you the national debt clock, I have a little app that shows me the national debt on this app. It's debtclock.org or something like that, and it's an app. Let me see if I can find the app. Let me see. I'm trying to remember what the freaking app was called, but I have it on my phone and I can't find it, so I'm kind of mad right now. Give me one second. Let me see if I can find it. Oh man, I can't find the freaking app. I'm so angry at myself right now. But there's an app I have on my phone called that's a national debt app, And I don't know. I hate this. I'm so mad right now. Anyway, it keeps up with the debt, and I was going to read it off to you, and it's about 37, 38 trillion dollars, which is an unbelievable amount of money. So as I read this article, I'm one of the experts that's very concerned. The problem with saying watch out is that you don't know when the other shoe is going to drop. I don't know if the correction is going to occur next week, if it's going to be next month, or if it's going to be next year. Nobody knows. Nobody knows when Cinderella's carriage is going to turn into a pumpkin. But I can tell you that it's going to definitely do that. I can tell you that right now, things that are happening in the market are not sustainable, and you really want to kind of be ready for that. That's my biggest takeaway from this. Whenever they take these surveys and they find out that everybody's feeling really bullish, what happens is that you create a market that trades on momentum, and it becomes very speculative. You see a lot of risk-seeking behavior, no different from the way teenagers with testosterone engage in risk-seeking activities, like they want to go and jump off a moving car just to impress a girl because teenagers are stupid and that's what we did at that time. And so basically so effectively what the market does is the same thing. They just get sort of financially drunk and they're buying anything. They're pushing the prices of assets up to unsustainable, illogical levels, and the crash inevitably occurs because you also create a very fragile state where the minute anything crazy happens, everybody's going to run. It's going to be a massive herd. Investors tend to invest in herds. One of my dissertation committee members, David Hirschleifer, who's a very, very wonderful guy. This is why I can't sit around and just be mad at all white people, because some of y'all try your best to be nice. And David Hirschleifer was just one of the nicest guys I ever met, and he helped me. He was responsible for helping me get my PhD. He's one of the best economists on the planet. He went to the University of Chicago, which is kind of the Vatican of finance. And he used to write a lot of papers about herding effects, and I would read his papers, and it taught me about how investors move. They move in packs like animals. So what happens when you get a herd of buffalo or a herd of zebras or whatever in one area, because they all come there because they think that there's food or something, whatever it is. And then what happens if you shoot off a shotgun? Well, then you're going to have a stampede. Do you understand? You get a stampede as soon as something triggers. So effectively, as soon as the economic shotgun goes off, it is going to happen. Something, I don't know what it's going to be. They call these black swan events. So at some point, the shotgun's going to go off, the herd's going to stampede, and you're going to see blood all over the headlines. So a good way to prepare is to just do basic things to protect your portfolio: stop loss orders, put options, sell some off the top, diversification. There are a few little strategies you can use. I did a whole training for you guys on this, about 2.5 hour training. You can go to stormproofinvesting.com if you want a copy of that. That's stormproofinvesting.com. Do I think that it's time to buy? Here's another part of this that's going to sound a little bit hypocritical. I don't believe in necessarily shifting your strategy too much based on what you think is going to happen, because these things are really hard to predict. So, one example is that there was a guy who he absolutely positively freaking knew that the Chinese government was lying about its real estate market. He knew this back in 2014, because what happened was you had companies like Evergrande that were growing to valuations in the hundreds of billions, and they were building all this property and taking on all this debt to build all these apartment complexes. And he said, I don't believe that they're selling all these units. I don't believe that there are people moving in. And so what he did was he got on Google Earth, and he would look in the different cities. He said, I think some of these cities look like ghost cities, like nobody lives there. And then he visited China, and he went to some of the different cities and saw that some of these cities were literally abandoned. And he knew in 2014, 2015 that eventually the bubble was going to pop. Eventually the chickens would come home to roost, and everybody would the stampede would kind of occur, and the Chinese markets would start to stumble. The real estate market would crumble. The problem was he bet on it too early. It's almost like when I'll tell you one thing that happened in my life. I knew R. Kelly was going to go down in 2004, 2003. I said, why are we still supporting this guy? He's a child molester. Like, why am I the only one who's seeing that this guy is a disturbed human being who needs help? Why y'all celebrating this man? Again, I was 20 years too early, 15 years too early, because it wasn't until 2017, 2018 that people started to really talk about it. So sometimes you can be right, but you can be right at the wrong time. That's my point. So this guy who was right about China, and that's what happened. Eventually, Evergrande could not make its debt payments. The real estate market crumbled. Now the entire Chinese economy has sank under the weight of its overcommitment to real estate, but he was about a decade too early, right? And he did eventually make money, but he lost a lot of money at first because the herd was going in a different direction. So it's very difficult to predict when the stampede is going to occur. That's my point on this. So everything that I'm saying here is true. At some point, this is going to end. Right now, according to this article, it looks like investors are feeling really good. Money managers are investing heavily in equities. There could be some more upward momentum. When the market has this much momentum, you trade on what they call the bigger fool theory. The bigger fool theory is that I'm going to be foolish and I'm going to overpay for this stock, even though I don't think it's worth what I'm paying. But I believe there's a bigger fool out there than me who's going to pay more than I paid for this stock. That's what the bigger fool theory is based on. So it says here that still that optimism has some investors concerned that a reversal is on the way. It This is crazy. I didn't even know they were going to say this in the article. Watch this. In November 2021, the last time Wall Street was this bullish, the S&P 500 capped off a strong year, advancing more than 26%. However, the following year in 2022, the broader index slumped more than 19%, driven by the Federal Reserve starting to raise interest rates, which sparked a correction in large cap tech stocks. What did I just tell you? We just looked at the chart and I stopped in November 2021 and I said, what happened after that? Now, here's the difference though. In that particular regime, you had a Fed that was increasing interest rates. So the Fed helped along the slowdown by hiking interest rates the way that they did. The Fed isn't going to be hiking interest rates this time around. So that creates yet another variable, another question mark. Nobody knows. Nobody knows. So I think that a good approach might be to prepare for the worst, hope for the best and prepare for the worst. That's the point. If you've been making money and your portfolio's booming, which a lot of your portfolios are, take some precautionary measures. Again, stormproofinvesting.com. That's where that training is. If you want to go take a look at that. And make sure you've got the safeguards in place. And then if you want to continue to buy, continue to invest, continue to look to the upside, you can do that. And I know some of you that are selling stock options and things like that in the Prime program, those sideways and down markets are great times to sell options because even though the value of your portfolio is going down, you're still making income from your stocks. So in 2022, a lot of you that were doing Prime, you saw your stocks going down, but you were able to generate income that entire time. And now your stocks are going up. And so your biggest concern is that your stocks are going to go past the strike price and you'll lose your stock. But that's better than the previous market where your income was a protection against the downside that you were already going to experience just by owning the stocks. So stocks can be a little bit of a roller coaster ride. That's why a lot of people are afraid of them. But the reason you don't want to be afraid is because long term, the good outweighs the bad. That's the nature of being an investor. That's the nature of being a wealth builder. That's the nature of being an owner. When you are the owner of something, you deal with the good and the bad. It's like being a parent. If I choose to be a parent, I've got some bad days with the kids. Sometimes they get sick. They get on your nerves a lot. They do crazy stuff, but the good outweighs the bad. Do you understand? So when you own things, that's what happens. You create that volatility. All right. So let me read a little bit more and put your question in the Q&A section if you'd like to do that. And also a stock that I like right now, I mentioned this morning in our financial consciousness training is Nurex Therapeutics. The ticker symbol is NRIX, NRIX. And another one is a company called Celsius, and that ticker symbol is CELH, CELH, Celsius and Nurex are the two stocks I bought. If somebody could type those tickers in the chat for me, I'd appreciate that. Because what always happens is someone doesn't catch it and then they ask me to repeat it, and then I may not see it, and I don't want you to think I'm ignoring you. So if somebody sees somebody say, well, what was the ticker again? If you could give it to them, I'd appreciate it. So let me say it one more time slowly so everybody has it. Nurex is NRIX. That's N-ARA. I know remember to say ARA. NRIX. And Celsius is CELH. CELH. Okay. Just like CeeLo with an H. All right. All right. So let's keep going here. It says, in fact, investors are concerned about the potential for greater volatility in the second half of 2024. So volatility, interesting, like up and down, up and down. The fund manager survey shows inflation fears have eased in investors' minds, though it remains the top concern. So inflation's their top concern, while concerns of geopolitical risks in the presidential election have grown. Yeah, if there's craziness in the presidential election, that can affect markets. I think Wall Street likes Trump more than they like Biden. And also Silicon Valley, ironically, likes Trump more than they like Biden because his administration has talked more about regulating technology and regulating AI and all that, whereas Trump has kind of said, "I'll let you do whatever you want," which can be a bad thing or a good thing depending on how you look at it. But that's kind of what I've been noticing. So they said inflation is the number one risk on investors' minds, according to 32% of investors, down from 41% in May, followed by geopolitics, which is the stuff going on in the Middle East, and the U.S. presidential election. Okay. For the moment, however, the market view appears sanguine, according to the survey. Roughly two-thirds of money managers are in the soft landing camp, where the economy slows but doesn't tip into a recession, firmly matching the consensus view. Okay, so they said 80% of investors anticipate at least two or more interest rate cuts over the coming year. So again, if you while I did lay out that doom and gloom scenario to say that in November 21, when the market was going way up, that it did go down the following year, that doom and gloom scenario does not apply necessarily, may not apply to this situation because in that situation you had a rising interest rate environment which artificially deflated stock prices, whereas now you have an environment where rates are going to be cut, which creates a level of optimism based on the expectation that once the Fed finally commits to start cutting interest rates, it will put stock prices up. Most economic valuation models for stock prices or any other fundamental asset out there pretty much are structured in such a way that when the interest rate drops, the price of the asset goes up. That will be true for your house. It will be true for an investment. It's true for a stock. It's true for almost any asset in the universe. They're all valued based on the same economic model. And in that model, when the interest rate drops, it's what they call the discount factor. When that discount factor declines, the price of the asset tends to bubble up a little bit. And that's why stock prices did so well during that 10 years before the pandemic, because you had what they call an easy money regime, where money was floating around everywhere and it ended up just pushing up the price of everything. And it also changed investing behavior. There were a lot of people. I remember I sat on a panel with a guy that I really liked. His name was 19 Keys. And I remember he was arguing with another guy because the guy said, "I don't really like to take on a lot of debt." And I remember 19 Keys said, "No, you have to take on debt because you put your money in the bank, you're not going to get any interest." And that was the argument I heard a lot of people make. But I said, actually, that's because of this environment that we're in right now. The Fed has made it that way. I think there are going to be some problems with that. I really do. I think long term there's going to be some challenges. And also, what it did was the fact that money was so easy to borrow during that 10-year period from, say, 2010 to 2020. A lot of people invested in really stupid projects. There were a lot of multi-billion-dollar businesses and funds that were created that deflated and died. Like I know a lot of the people in our community were talking about the Tulsa Fund, about $13 million, which was very, very bad. But you're talking about $100 billion projects that just died because it was so easy for banks to get money. So access to capital actually is the thing that I would love to see the most for any investor out here, because it's access to capital that builds wealth. It's not necessarily having money, it's having access to other people's money. That's why Elon Musk was able to build Tesla, is he had access to other people's money. If he didn't have other people's money, he never could have made money on his own. All right, so anyway, let me keep going. All right, so I'm gonna look in the Q&A section. And a reminder, in case you don't come to Money in the Morning, our financial consciousness training where we discuss the art of economic elevation every morning, just get on the text list. Text the word morning to 87948, and the live trainings are free. So just text morning to 87948. We do that every single morning at 10 a.m. Eastern. And also earlier today, I was mentioning to you all that the All Black National Convention is going to occur October 25th through the 27th in Lombard, Illinois, which is right next to Chicago. So if you're B1 and this is your thing, and you want to hang out with other people like us, then feel free to come to the convention. I hope you'll join. You can go to allblacknationalconvention.com, and there's a discount code that's in effect for 48 hours. And the code is 50 off A, B, and C, all one word, 50 off A, B, and C. If you go to allblacknationalconvention.com and use that code, you can get half off anything that you want to get. All right. So Tawana says, what is your take on investing with AI, and what is the best platform? I think you can do a lot with regular AI platforms, Perplexity, ChatGPT. I think that investing with AI can be beneficial because AI is pretty smart and they can really help you work through a lot of issues. I think also AI is just something everybody should understand and really, really dig into, because AI is going to be the wave of the future. In fact, I made a list of stocks that you can invest in that will make money as AI grows. I believe in this list. These are all companies that I've invested in. I think I invested in every single one of them. So if you'd like to get that list of stocks, just text the word stock to the number 87948. Text stock to 87948 and you'll get the list. What platform should you use as a beginner? I use Cash App. I was thinking about Webull. I think both of those are fine. I like Webull better than Cash App. I think as a beginner, it really which platform you pick doesn't matter so much. Most platforms have good education and good explanations in terms of how to use things. They have great customer service. E-Trade's customer service is great. Schwab has great customer service. Fidelity, even Robinhood's gotten better. And so if you want to get started, if you haven't started investing yet, which I really hope that you'll do, if you go to blackwealthmasterplan.com, there's a free ebook there called the $5 a day plan that can help any family go from any income level, any socioeconomic level to middle or upper class in about 10 years, actually. So feel free to go to blackwealthmasterplan.com. I talk about the $5 a day plan a lot because I just know the power that it has. I mean, if you think about that, in the first decade, if you just invest $150 a month, which is about a fourth of what a lot of people spend on their car notes. A lot of people spend four, five, $600 on their car note. So I said, if you just put $150 a month in the stock market for yourself and for your kids, then your kids won't suffer financially when they get older. They won't be like all these other millennials and Gen Zs that can't pay the bills. That won't be their story. Their story will be my mother and father invested for us a long time ago. So now I've got $100,000 liquid sitting in the bank just in case I need money. Because in the first 10 years, you actually have close to $29,000 liquid. If a person had done this over the last 10 years, they would probably have in the 30s. It'd probably be 30, 33, 34,000. I got to double check that. And then after 20 years, it's about 102,000, give or take a few $1,000s. And then after 30 years, it is nearly a quarter million. After 40 years, it becomes $750,000. And so this is how any parent, any grandparent can make their child wealthy by a certain age. Also, if you increase that number from $5 a day to say $20 a day, then you're a multi-million dollar family. And it's very easy to do. It's as easy as paying your rent. It's as easy as paying your car note. It's as easy as paying your cell phone bill. So I say that before you pay the car dealer and the landlord, pay yourself, pay your family, pour into your legacy. That's the most important thing you can do. All right. Now, the discount code for the convention again, and if somebody could keep that around in case you see a question, somebody's asking for it again, it's 50 off A, B, and C, all one word, 50 off A, B, and C. I'll type that in the chat too, so you can see it. And the URL is allblacknationalconvention.com. So if someone sees someone ask about it, if you could let them know what it is, I'd appreciate it. That way I don't have to, I can make sure we stay focused on what we're doing. All right. So next question is, if I request dual citizenship, where do you recommend? I don't know, maybe the US and Ghana or something would be kind of fun. I think Ghana makes it pretty easy to have dual citizenship. I'm Team Africa in that way. Is this an optional stock? Asked Barbara. I don't know what you mean by an optional stock. Every stock is optional. There's nothing that you have to do. So I guess the answer might be yes, based on that definition. Are you able to look at Ricey Rolls-Royce? I don't know what Ricey Rolls-Royce is. Is that a company? You mean look up Rolls-Royce stock? I don't know which company. I don't know if they're publicly traded. Let me see. Let me see if I can find Rolls-Royce in here anywhere. Rolls-Royce. Oh, RYCIEY. Okay, I got it. Sorry about that. Yeah, they develop, design, manufacture services, integrated power systems for use in the air, land, and the sea. The company operates its business through civil aerospace power systems. Yeah, Rolls-Royce. So, okay, they're in London. So this is the Rolls-Royce. Okay. It's a very risky stock. It's about it's a little less than $6 a share. The analysts like it. I wouldn't get mad at you for putting it in your portfolio. Um, yeah, I mean, sure. Why not? Why not? I mean, it doesn't look terrible. Is Para okay? Asking Lane for options. You talking about Paramount Global? I don't like Paramount. I don't like. Oh, what is CELH? That company is Celsius. Now what do they do? That I don't know. So let's see here. CELH. Celsius. They engage in the development, marketing, sale, and distribution of functional drinks and liquid supplements. So there we go. And I pick stocks based on what the analysts say. I don't listen to. It's like if you're like almost like a doctor. A smart doctor doesn't just go off of the tests and stuff like that. The doctor would also talk to the child's mother and find out how the child tends to operate and whether or not the child is behaving abnormally or whatever. So analysts are like the parents of a stock. They're the ones who monitor the stock constantly, and they can tell you based on sitting on hours and hours of analyst calls what they're seeing in the future of the stock. They also sit down and they put all those numbers through computer programs that calculate economic valuations, and then they come up with an assessment. That's far better than you trying to do it. Your expertise level on a given company never exceeds the analyst. So the analysts are the ones to listen to when it comes to stock. I work for a registered agent. Would it be a conflict of interest to invest? Could this be on the border of insider trading? I would encourage you. Well, when you fill out your form to invest with a given app, they're going to ask you questions like that. They're going to try to find out how affiliated you are with the financial industry. So there may be reporting requirements connected to that. So if you're not sure completely after you fill out the forms, we'll fill them out honestly. You don't want to lie on these forms, and then maybe talk to customer service and let them know your situation. They could tell you what your issues are. Let's see, Dr. Boyce, I can't find NRIX on Cash App. Yeah, I'm sorry, Priscilla. Some stocks are not listed on all the platforms. This one's listed on E-Trade. I don't even know if it's listed on Robinhood. So, but it is on Robinhood. It's on Robinhood. It's on E-Trade. It's not on Cash App. And the interesting thing about the stock too is if you bought it this morning, I think you might have made money since this morning because the stock has been on fire today. I didn't know it was going to do that. Let's see, right now it's 11:30 Central. Yeah, when we talked about it, it was at 9 a.m. Central. Holy crap. Oh my God. Has anybody paid attention to this? I mean, I didn't know it was going to do that today. But when I mentioned it this morning at 9 a.m., it was trading at about uh it's gone up about 3.5%. So since this morning. I like it because of what the analysts say, Cameron. I look at analyst reports. I don't really try to and this is another thing. I don't think if you ever learn stock market investing and they have you going through all the reports and looking at all the ratios and calculating all this and stuff, I think that's kind of a waste of time. I don't think that it's not that those ratios don't matter. It's that you don't know what to do with that information. Like I could give you 50 books worth of information on a company. And first of all, it's going to take forever to go through all that. But then number two, what do you do with that? How do you know? Do you really know if this stock's market price is lower than its fundamental value after you go through all this information? I can tell you this. I spent years in a PhD program, and it took us a long time to be able to come up with an assessment on a stock. And even then, in many cases, we'd be wrong because if you look at 20 different analysts who are all studying the same company, you might get 20 different responses to what the valuation of that company is. So sometimes looking at what the majority of the analysts are saying is one metric that you can use, but even then that's still not precise. So another thing you can do is you can form portfolios. Healthy portfolios is the way to invest. You don't want to think in terms of individual stocks. You don't want to say, "Oh, this is my stock that's going. This is the one. This is the horse that's going to hit." That's gambling culture. I don't think that that's the best way to invest. That's not the best way to build wealth. You want to build portfolios of quality companies where some things go up, some things go down, but overall, as the economy grows, your wealth grows. That's the safest long-term way to invest. I don't follow any particular analysts, Barbara. I look at them all. I look at, if they say JP Morgan Chase has an argument as to why a stock's going to go up, then I'll read it. If they say Goldman Sachs has a different argument and thinks that it's going to go down, I'll read that too. I want to hear what everybody says. And then at the end of the day, where I pick a stock, it comes down to where do I want to be? What do I believe in? It's like if you were to look at the Super Bowl and you have two evenly matched teams and you're trying to decide which team you're going to cheer for or which team you're going to bet on, sometimes you can never really be right because you don't have a time machine because you may have two teams where on a given Sunday, one team would win. On another type of day, the other team would win. So it's not about necessarily being able to be right. It's about sort of having an assessment that allows you to understand what risk you want to be exposed to and where you want to be in case certain things happen. So, for example, I talked to you guys about copper. I'm a heavy investor in copper. And I'm doing that because I believe that the demand for copper is going to go up. I believe it's going to become more scarce. It's hard to build, and open and operate these copper mines. I think that as time goes on, is going to be an industry of growth. That's why I'm invested in copper. I'm not invested in it because I know that COPX, which is what I invested in, that's the ETF, COPX. I don't know what COPX is going to do next week. I don't even care. I just know that if you ask me what am I invested in, I'm invested in copper. So think about when you picked a career. A lot of you have a career, right? A lot of you went to college or something and you majored in something and then you picked a career. That was just your career. You just picked it. You don't know what the future holds necessarily. You kind of do. You know that this pays well and there's job opportunities there, but you don't know what that career is going to be like 5 or 10 years from now. So you just, you're invested. If you're a nurse, you're invested in nursing. If you are an engineer, you're invested in engineering. If you picked a spouse, a wife, or a husband, you're invested in that person, just like they're a stock. And sometimes it's going to have a good year, sometimes it's going to have a bad year, but that's where you chose to allocate your resources. If you own a vineyard, you're invested in vineyards, right? So being invested in something isn't necessarily a magical thing. I think sometimes though, what happens is that you don't pick things that you may not pick industries that are just terrible industries or where you expect bad things to happen. Or you may be in an industry for a while and then you realize that that's not the place for you. So maybe you reallocate some part of your portfolio, just like a bad marriage. I've been married to this lady for 5 years, and the first 3 years were good. The last 2 years were terrible. I got to get out. So I think I'm going to reallocate my portfolio. Instead of investing money, I'm investing something more valuable than money. I'm investing my time and my peace, my inner peace, and I'm going to invest that in a new person. All right. So that's kind of the way to think about investing. You cannot really typically invest with a crystal ball, and there's no investor in the world that goes through life and never loses money. If you're a standard investor, typically you're gonna have your drought seasons and you're gonna have your booms and your busts. And it's the booms and the busts that cause people to be scared to invest because the thing about the other route where you don't invest at all and you just get your paycheck and you just spend it until you need another one. That route is smoother because you're going to get the same amount every week, but you're kind of like dealing with this consistent level of mediocrity. Whereas with investing, you've got opportunities to see your wealth grow and to see it grow in a way that's really efficient without you having to go to work until you die, or also in a way that tends to exceed the rate of inflation. Like when I showed you all that chart and I showed you how much the market has gone up since the pandemic, well, that asset inflation was higher than regular inflation. So even as inflation was 7, 8%, the people that were getting hammered the most by that high inflation were not the stock market investors, because the stock market investors, they said, yeah, the price of carrots is going up at the grocery store, but my Nvidia stock shot up 10x, in the last year or whatever, right? So they've got a balancing factor. So the question that I want to ask you, and this is the last thing I'm going to say on this point, and I'll get back to your questions, is do you have balance? What is your balancing factor? This is the reason why you don't want to just be a person that goes to work and gets your paycheck and lives off your paycheck, because your boss is not balancing out inflation for you. They're not giving you raises that keep up with inflation. The studies all show that. So what's your balancing factor? Well, investing becomes a balancer that lets you keep up with a changing society. So if you're sitting on the sidelines and you're just scared, I don't want that for you, because you're really watching the world run by you. And I don't want you to get left behind in that way. So you got to participate on some level, in my opinion. Every person that's smart should be in the stock market consistently and assertively on some level, where you are just as invested in the stock market as you are invested in buying the iPhone or paying the rent or paying the car note. It should be at that level. It shouldn't just be $2 here, $20 there. No, this is something that it has to be a fundamental and critically important part of your life. I'm done. Thank you for listening. All right. And if you haven't started investing, we're going to do something next week. I'm going to do a live event called How to Invest in the Stock Market. It's pretty straightforward. So I'm literally going to walk you through the process for those of you that still aren't sure. I'll let you guys know when that's ready. It's going to be, I'll tell you in a couple of days about it. Secondly, if you're eager to start something today, I did do a Black Stock Market weekend that anybody can access. If you go to thedrboycemethod.com, thedrboycemethod.com, there's a 11-step process I put together where you can go step by step, and it'll help you pick stocks for your portfolio. All right, so Kevin says, what percentage of the total stock portfolio should you target for your largest holding? I don't do more than 5 to 7% in any one particular asset. I don't, that's what, and fund managers pretty much do that too. You want to keep that low. That way, you know, um, that way there's no one particular tiny economic disaster that can destroy you. If you hear about athletes and entertainers that lose all their money, like I invested and I lost everything, that means that they were investing badly. Is Rolls-Royce a good stock for options trading? I don't think it was, Olivia. I mean, I guess I can look at it, but I don't think it is because the price is so low. It's a $5 stock or something like that. Um, so typically stocks like that are really hard for options trading or options selling. Now you could buy options. In fact, they don't even have an options market. It's what they call an American depository receipt, which is a way for foreign companies to be listed on the US market. Doc, what stock went up 3%? That's NRIX, the one we talked about this morning, Nurix Therapeutics. So if you did make some gains, maybe you took advantage of that investment. I didn't, just so you know, I can't tell you which stock is going to go up this morning. And we just got lucky today, but that's cool. I'm glad. If you invested and you bought it, then I'm happy that you made money. It looks like I made some money too, so I'm really happy about that. But then again, though, I own hundreds and hundreds and hundreds of companies. So really, when one company goes bad or goes really good, it doesn't change my life that much. It doesn't make a difference. So, and that's what I really think you should consider is just make investing part of your culture. It has to be. That's critical. Let's keep going. I just sold a few puts on NIRX at 450 for this week. Is this a glitch? You sold puts on NIRX or NRIX, the stock that we talked about earlier. I don't think it's a glitch, Justin. I mean, if you sold the puts, then if you sold the puts, I guess before the price went up, you probably lost money on your puts. If you sold them after the price went up, then that's a reasonable strategy because maybe you're expecting a price reversal. There is some evidence to say sometimes stocks do that. Sometimes if they have a big jump, they overheat and then they come down a little bit because people start profit taking. They start selling off their gains to protect their gains. That's a good strategy. So let's say you have a stock that you bought for $1,000, $1,000 worth of stock, and it goes up to 1,500 or something because you had a great earnings announcement. Well, maybe a good strategy would be to shave off $200 or $300, and that way you've got that money protected so that if the stock goes down, it's not going to hurt you. Also, selling call options is a great way to protect your investment because that is something that a lot of people use. A lot of people sell cover calls to generate income and to protect their investment. It's a conservative bearish strategy. And if you don't know how to do that, just go to drboyceprime.com and you can take a look at what we do in the Prime program. Okay, the strike is 2250. Okay, well, good luck. I don't have an assessment on that, Justin. I don't know what let's see. I don't know what your let's see here. I don't know what the price was when you bought the puts, but I guess if you bought them in the money, because I guess the price of that stock was never above 18. So if you bought them in the money, then maybe you could have lost money. But if you bought them after the price went up, maybe you made money. It kind of depends. That's really more trader conversations. And I'm not a big fan of living in the trader space because it requires a lot of your attention. It creates a lot of financial anxiety. And if you're not careful, you can become a gambling addict. A lot of traders are gambling addicts that they just don't know that they are because they think they're investors, but that's not really investing. High frequency trading, like when I bought an option and I bought an option today for I put down 1,000, I turned it into 5,000. That's really not. I mean, that's fine. It's something, but it's not investing. It's not long-term investing. It doesn't tend to, based on most research studies, make money consistently across the board. But what makes it misleading is that people who do this, they tend to tell you when they made money. They don't tell you about all the money that they lost. So you got to kind of think about that. All right. Do you agree or disagree with the average investor? 100% in VOO is a good strategy. It's not a terrible strategy. I mean, to me, that's far better than nothing. Now, maybe 100% might be a little bit drastic, but VOO, let me see. That's Victor Oscar. Let's just look at that fund really quick and kind of talk about that. So let's see. All right. So VOO, the Vanguard S&P 500 ETF, it's passively managed. It holds large cap US stocks. The top 10 holdings are Microsoft, Apple, Nvidia, Amazon, Meta Platforms, Alphabet, Berkshire Hathaway, Alphabet, Eli Lilly, JP Morgan Chase. And it looks like the top 10 holdings are 34% of their assets. The sectors that this fund is in, they have 30% of their investing in technology. So it's tech heavy, 2% in real estate, 6% in consumer defensive, 10% in consumer cyclical, 12% in financial services, 12% in healthcare. So what would I say this? Let's say that you had a person, if you have two people and one person just says, I'm going to invest 100% of my assets into VOO, and I'm going to, every time I get paid, I'm going to put $100 a week into VOO. And that's what I'm going to set it on my app, and I'm not going to look at my app again for another 10 years. That person's going to have 10 times more wealth than, say, their friend who didn't invest at all, who said, I'm going to take that $100 a week and I'm going to go down to the casino boat, or I'm going to spend it on whatever, going to the mall and stuff. The person who puts $100 in VOO over a 10-year period and does that consistently every single week is gonna, on average, have roughly um about $95,000 liquid. So you and I both work at Applebee's or something, and I hustle up $100 a week, and I say, this is my big move, this is my play. I'm gonna have $100 a week go into VOO every week, and I'm not gonna change that strategy. So over 100 years, or sorry, not 100 years, 10 years, I'm sorry. That $100 over a 10-year period would be $120 a year over 10 years. $120 a year is what, $1,200? Is that right? No, no, sorry, I scratched that. I did that totally wrong. $100 a week for 52 weeks is 5,200 a year. 5,200 over 10 years is 52,000. I did that math totally wrong, didn't I? So what happens is during that time period, my money does more than double. My money goes up to roughly about 130, 140,000. I said 95,000. Um, it's actually in the last decade, it would be over $100,000. So I want you to think about that. I need you to meditate on that. This is why I do financial consciousness, because sometimes we don't meditate on how transformative that is. Um, because if you are committed to the slow money process, if you let go of the fast money BS and the fast money lie, and you commit to the slow money truth, the slow money is the sturdy money. The slow money is the real money. The slow money is concrete money. Then that person who worked with you at Applebee's 10 years ago, they're now considered a rich almost, because they got $100,000 liquid in their stock portfolio. Most people don't have that. Most working class people don't have that. So the idea that a person who could be making minimum wage, who could somehow find a way to muster $100 a week for something, think about how many other things we would spend $100 a week on. And the fact that that could literally put them at a level where they're now considered almost like rich compared to all their friends is absolutely astonishing to me. And then what happens is that it's not just changing your economic situation that decade. That's the beginning. What you've done is you've really murdered a generational curse in broad daylight, because now those assets can continue to grow. That's the beginning. The first 10 years is the beginning of an investment portfolio. You keep going over 20, 30 years. So after 20 years, you're talking about, several $100,000, maybe three or 400,000. After 30 years, they're well over $1 million, right? So now you're a millionaire now. And as a millionaire, you're able to then talk to your children, sit them all down, as a wealthy person, because you have made the decision to make your family into something significant. You've made the decision to make your last name mean something, because now you're a millionaire family. And now you've got assets you can distribute to the children. And then if you distribute the assets with knowledge on how to manage the assets, like the discipline to manage your assets is really a way of protecting your freedom. You're saying to your kids, look, we got this 1.1 million that I've invested, and I built this wealth since I worked at Applebee's 30 years ago. I'm passing this on to you, but I need you all to be financially intelligent and financially disciplined, because this money is our freedom. If we lose this money, if we can't be self-disciplined, then we're going to have to be disciplined by somebody else. If we can't be self-disciplined and protect our freedom, then we're going to have to sell ourselves back into slavery, because that's what it is when you're tied to the corporate plantation. What's occurred is you've had to sell yourself into slavery because you don't have enough money. And so ultimately, what I just want you to really do is really reflect on that, on the opportunity that you have to make such a big difference. And because if you tie that back to how many people go through the internet and look at all the shenanigans that occur over small amounts of money. I saw this crazy story. It was so goofy. It was on Shade Room. of this. They put the most ignorant crap on there, right? But I pay attention because I like to see where the culture's going. This is why the wealth doesn't get built because people are distracted by stupid stuff. And there was an NFL player who slept with a girl from OnlyFans, and he agreed to pay her money to have sex or something, and he didn't pay her, and then she's chasing him down the street naked because he didn't pay her the money. And I was sitting there thinking, I said, God, this is so sad. Where's her daddy at? Like, if her daddy had invested for her, she wouldn't have to sell her body to this man. And then this man looks as pathetic as can be because, again, I don't agree with paying for sex, but if you're going to pay, like, at least pay what you agreed to pay. You look shady right now. You look kind of dusty right now. So you got these dusty situations happening that could have been prevented if somebody's parent had made a different decision. Do you understand? So when I see a weird incident that happens in 2024, it tells me that somebody didn't do what they were supposed to do back in 1994. So do what you got to do in 2024 so your kids won't be in dusty situations in the year 2054. That's the end of my speech. Thank you for listening. All right. So when the market reverses, what percentage do you take off the top from your stocks? How do you know which stocks to take from? There's a lot of factors that come into that. There's no particular percentage. There's no raw percentage. Investing is very emotional. And that's why we developed the Black Financial Therapy Department in the Black Business School, where we work with the best therapists to understand the psychological barriers that keep us from building wealth. And so ultimately, a lot of investing comes down to how you feel. If you feel that taking 10% off is going to make you feel safe, then that's okay. If you need 20% taken off, that's fine too. There's no percentage and there's no rule on which stocks. Sometimes people sell their stocks that have lost money so they can write the losses off on their taxes. Some people sell the stocks that have done the best because they feel like they can't go up any higher. It's really a personal decision. Now, if you want to know some ways to kind of deal with, well, the downturn, stormproofinvesting.com is all about preparing for the worst, because the worst, I think, is coming probably later on this year, maybe early next year. So stormproofinvesting.com. Also, if you log in at the blackstockmarketprogram.com, there's plenty of stuff there as well. All right, so let's keep going here. All right, so let's see. Justin says it was a covered call. I thought you said you sold a put. Because I saw put, but you said covered call. So if you sold a call and then bought a put, um, okay, that makes sense. That's a collar. I mean, that can protect your investment. That's a good way to make income. Let's see. What type of business is CELH? I think we read that earlier, Barbara. Let's see. Okay, next question. How do you determine when to do a rollover or rolling up with selling covered calls weekly? I do rollovers and roll-ups based on whether or not I want to keep the stock. So if you want to keep the stock and not have it become a taxable event, then that's what a roll-up is. We'll do a prime class soon. So if you're on the prime list, if you're not on the prime text list for options, text the word options to 87948. I'll send you guys a link soon, and we're going to have a prime meeting, and we'll talk about all this stuff. Also, if you log in at drboyceprime.com, there's information there in terms of a way you can actually leave me a question and I can answer your questions about options on video. This is more so for stocks because some people don't understand options and I don't want to talk over their head. Let's see here. Dr. Boyce, I started following you some years ago when you were teaching your son stocks. I really wish I would have taken this serious. I'm in my 40s now. Do you suggest options trading if I want to retire at 60? I think options trading, I don't think that's going to help you retire. I think that I think selling options to make will make income for you. I think options can also be used. Remember, options aren't just used for speculation to make money. They're also used to protect your wealth and stuff like that. There are some strategies that are there. Let me see. I think I did a stock options training. What is it? Stockoptionsmasterclass.com. I think, yeah, if you go to stockoptionsmasterclass.com, you can see the one of the stock options boot camps that I did. And one of the things I want you to really understand about stock options is that most of the people that are teaching stock options are really only covering about 5% or 10% of what options can do. They're covering the cool part. The cool part is that you can invest $1,000 and possibly flip it into 5,000, which I agree, that's very, very cool, but it doesn't happen very often. And most of the time you just lose your $1,000. The other things options can do is they can generate income, sometimes enough income for you to quit your job if you want to. Options can be used to mitigate risk. Options can be used to replicate ownership of a stock. They have a whole stock options stock stock replication strategy. Sorry about that. Where you can buy options in a certain way where it simulates the behavior of the stock, but you don't have to pay the same price. So the stock might be $500 a share, but instead you might do an stock replication for 150 or something, and it still gives you the same movements as the stock. Okay, and I can answer one more question, two more questions, and then I'm going to head on out because we have a meeting today for the All Black National Convention, and I need to go and talk to the team about that. And by the way, if you want to come to the convention, it's going to be in Lombard, Illinois, October 25th through the 27th. For 2 days, you guys can have 50% off the tickets if you want. We are going to sell out, so we're not offering the discount because we're trying to sell tickets. We always sell out. I'm offering the discount because I want the right people to come. I don't want a blowout festival. I don't want something with thousands of people. I want the right people there that have the right ideas, that really want what's best for our community and put our community first. So if you're in that category, if you'd like to join us and meet the others that will be there, you can go to allblacknationalconvention.com. That's allblacknationalconvention.com. And the discount code is 50 off A, B, and C. That's 50 off A, B, and C. All right. So let's see. Renee says, can you speak on older people 65 plus investing? Yes, Renee. One thing that comes to mind when you talk about older people and investing, older meaning retirement age, is number one, after you retire, your life expectancy goes up just by virtue of the fact that you've made it as far as you have. You're expected to live a long time. So let's say you live 20, 25 years after retirement. That's a freaking lifetime when it comes to stock market investing. Like you can still grow wealth like everybody else. You still have plenty of time like everyone else. And so I don't believe this idea that you should just sort of assume that you're done because you've hit retirement. I think that assertive investing in retirement is fine because most of the time, even if your stocks go down, it takes no more than a couple of years typically for stocks to come back up. So a lot of what they call risk of a crash, when people talk about crashes and crashes are bad and what if it crashes? Well, crashes go away. There's no time when the markets crash and it didn't recover. So if you invest in 2026 and the market crashes in 26 and it recovers by 2028, okay, you waited out the storm just like you do when it rains. When it rains, that doesn't mean you're going to get wet. You're only going to get wet if you have to leave the house. So don't leave the house till the rain stops. That's what, so I think you can do that in retirement just like you can do when you're young. The second piece to that too is I talked to a senior citizen. I've talked to several senior citizens who've thought this way, and I had to give my perspective and hopefully a point of view that helped them to see things differently. So they would always say, Dr. Boyce, I'm 70. Do I have enough time? Or I'm 65 and I don't have much time and stuff like that. And you're in time, and you're right. I mean, you're not as young as you used to be. There's no question about that. Time is ticking for everyone, but you got plenty of time. If you're 70 years old, you got all the time in the world if you remember one simple fact. Investing is not an individual endeavor. Investing is not just for you. Investing is not all about you and how much money you have and how good you can live until you die. You think the world's going to stop spinning because you died? Are your grandbabies not going to still be black because you died? Is the world not going to keep going on just because you died? Like, is it over? I mean, because if that's how you think, then I either need to help you to elevate your thinking, become more financially conscious, or maybe I'm the wrong person for you to talk to because investing is a team sport. In fact, wealth building does not work if you are selfish. It doesn't work. Wealth operates on various ecosystems that require cooperation among multiple entities and multiple people. So that means that I'm not investing just for me. Sure, I get to live a nice life because I invest. Me and my wife, we travel, we do all kinds of fun stuff. We drive luxury cars. We don't drive hoopties. We drive nice cars. So we live good off our wealth, but I'm not investing just for me. We got kids. I'm investing for them. They're going to have kids. I'm investing for children that are not yet even born. I'm investing for my children's grandchildren who won't even be here maybe until 30 years after I'm dead. Do you understand? Let me know if you get this point. This is such an important point, and I really think it's important, especially for those of you that have hit that grandparent age, thinking that it's over for you, or I made mistakes in the 1980s and the 1970s and 1990s, and so what I do doesn't matter anymore. No, everything you do matters. I mean, do y'all even understand? that I would not even be here talking to you as a finance professor if it was not for investments my grandmother made for me and in me when I was a little kid. Do y'all know that? My grandma been gone since 2012, but she lives because every single morning, if you come to financial consciousness training, my grandmother's right there with me. That's that panther right there behind me. Her name is Felicia. So my grandma's always with me. My grandmother, by investing in the way that she did, not just in herself, but in everyone around her, she created her path to immortality. My grandmother will never die. She will never die. So that's what I want you to understand is that, and I'm gonna end on this point because I think this is just an important point. I want us to just walk away and meditate on this. If you have a question, I didn't get to it. I apologize. I got to go to my meeting, but I think this is an important point for us to finish on, and I hope that you feel this the way I feel this. That's why I gotta stop on this. Not only are you not done, but your work has just begun. And if you do the work that has just begun, if you do it to the best of your ability, you can change living conditions for people that will be born decades after you're out of here. You will be able to leave an impact on your family that will last for 100, 200 years. And I'm not playing with you. I'm not kidding. My wife bought her first house in the year 2000 with money that her great grandfather invested for the family in 1945. He bought World War II savings bonds in 1945 that allowed his granddaughter to buy a house in the year 2000. She has a cousin that lives in a building on the south side of Chicago. Her cousin has never paid rent and makes money from tenants that are in a building that her parents grandparents bought in 1937, back when that building in the south side of Chicago cost about $5,000 or $6,000 and is now worth over $1 million. Do you understand? So I hope that this makes sense, and I hope that you really get this. If you think about wealth as a team sport, it doesn't just it gives you all the time and all the space that you need to do anything that you want. It gives you all the time. You have all the time in the world now. Because if I'm 75 and I create a trust and I allow that trust to grow, then that trust gets to grow for the next 30, 40, 50 years. It can take care of people after I'm gone. Also, if I think of wealth as a team sport, that then allows me to realize that by taking care of the team, I'm not sacrificing myself. So when I say invest for your children, invest for your grandchildren, I'm not saying don't invest for you. I'm saying you understand though, because you're in the ecosystem, that the more I take care of them, the more I'm taking care of me. That's why I mentioned to you that me and my wife, we invest like crazy for our kids, but we living good. Why? Well, because these assets are resources that we get to use and we get to enjoy until we decide to pass them on. Just like we're going to give one of our kids one of our cars that we've been driving for the last 8 years. Do you understand? So that's how you want to think about your assets. Don't think of it as either I'm doing for me or I'm going to do for them. It's never either or, it is both and. So I hope that that makes sense. When I do for me, I'm doing for you. When I do for you, I'm doing for myself. So just go into it with that mindset. And then what that does is that opens up the whole field, the whole football field, in terms of all the possibilities that you then have available to you to have the impact that you want and to live the life that you deserve. Okay, I gotta go. Have a great day, everybody. God bless you. And somebody looks like somebody said that stock we talked about this morning. Did it go up again? It hit a 52-week high. Whoa! I didn't know it was gonna do that today. Okay, that's great. Okay, yeah, the ticker's NRIX. I liked it this morning, but I don't know if it keeps on going up. Maybe it'll be too priced too high. I have no idea. I have no idea what's happening here. This is just a stock I researched this morning and when I mentioned. So anyway, I'll see you guys soon. And also, if you're on the Prime class, I'll hit you guys up about a class meeting very soon. If you want to receive text messages in the Prime program, or in you're doing the options stuff, then text the word options to 87948. Text options to 87948. And if you want the discount on the A, B, and C tickets, just go to allblacknationalconvention.com. That's allblacknationalconvention.com and use the code 50 off A, B, and C. 50 off A, B, and C, all one word. See you guys soon. Have a good day. Take care, everybody. Bye bye.